Okay, let's unpack this. Imagine finding a company that, well, almost overnight in early 2025, just flips its core business. That's kind of what happened with Porch Group. Suddenly, they're positioning themselves as a new kind of homeowners insurance company. Now, if you're listening, you probably want to get up to speed fast on what that really means. So that's what we're doing today.
Exactly. We're diving deep into Porch Group, ticker PRCH, looking at where they stood on May 7th, 2025. We've pulled together a whole stack of research, their Q1 earnings, the call, investor decks, analyst reports, you name it. The goal is to really understand the shift, look at the leadership, the financials, market sentiment, who owns it, and, the risks involved. And just so you know, all our sources, they're listed right there in the description if you want to explore them yourself.
Okay, so how are we tackling this? What's the plan? We've got a roadmap for you. First up, we'll break down Porch's new business model. Then we'll evaluate the management team, their history, and recent actions. After that, a close look at the financial health. Crucial numbers there. In the second half, we'll gauge the market mood, see who the big owners are, and lay out the key risks. Then we'll wrap it all up. All right, let's get into it. Chapter 1, Understanding the Business. This is where the big twist happens, right? January 2nd, 2025, they form this Porch Insurance Reciprocal Exchange, PRE, and sell their insurance underwriting business, HOA, to PRE. So they went from being the insurer to managing this new thing.
That's the core of it. It's a fundamental change in risk and revenue. Instead of holding the policies and the potential losses, Porch now primarily manages PRE. They get management fees, a slice of PIRE's premiums, policy fees, even money for sending homebuyer leads PIRE's way. Plus, there's income from some reinsurance deals, the non-catastrophic kind, and interest. They hold $106 million in surplus notes from PIRE. Think of those notes like, well, a loan to PIRE that also counts as capital for regulators, and that interest rate, it's SOFR plus almost 10%. Pretty hefty. In Q1 2025, this insurance services segment was like 59% of what they now call Porch shareholder interest revenue. So their success is now really tied to PIRE doing well, growing premiums, underwriting profitably.
Okay, insurance is the big piece now. They still have their other stuff, the software and data side. That was 26% in Q1. What's in there?
Right, that's their legacy almost. Software for the home services industry. It's mostly SaaS subscriptions, some transaction fees too. For home inspectors, they've got ISN and PalmTech. Huge penetration there. Something like 40% of U.S. inspectors use them. They have features like Flex Fund, paying at closing. For title and escrow, there's Rhino. They actually pushed through a 20% price increase in Q1, which suggests, some real pricing power. Then there's Floify for mortgage folks, Hire Helper for moving labor. They're number 2 in the U.S. for that apparently iRoofing for roofers, and other tools for realtors, contractors. It's all about embedding themselves in these professionals' workflows.
That's quite a range. In the last slice, consumer services, 15%. What's that?
Yeah, this is where they face the homeowner directly. Things like moving help through Hire a Helper and their new moving place platform launched early this year, even offering packing. Also, utility setup concierge services, connecting people with repair pros, and home warranties. That's American Home Protect and residential warranty services. They rolled out new warranty products in Q1 too. Trying to capture value across that whole homeowner journey,
And Porch talked a lot about this flywheel concept. Can you break that down? What's the theory?
The theory is, well, the software gives them early access to people moving or buying homes, plus all this property data. Then they try to monetize that access by selling PRE-managed insurance and all these consumer services. It sounds good on paper, but the real question is, how much synergy is really there? Does using their inspection software actually make you choose their warranty? What's the connective tissue? Are there real incentives? Figuring that out is key to knowing if the flywheel actually spins effectively.
So just to recap how Porch makes money now.
It's a mix. You've got software fees, mostly recurring. Then the big one, insurance management fees and commissions from PIRE. Add in the interest income from those PIRE surplus notes, then fees from consumer services moving, warranties, and finally, data and marketing services. They have home factors, data on like 90% of U.S. homes, and Porch Group media. It's diversified.
Okay, Insight 1.1, a big takeaway on the business model.
It's just fundamentally different now. The PIRE shift dramatically changes their risk, less direct underwriting exposure, and it aims for higher margin fee-based income. But, and this is crucial, it completely relies on PIRE being profitable and growing. Porch's fate is now tied directly to PIRE's success in the insurance market.
And Insight 1.2 on that flywheel.
The concept makes sense, strategically leverage software access, sell other stuff. But the execution is the hard part. Really integrating and cross-selling effectively across very different businesses, from inspector software to moving services. That's a challenge. If they can't bridge those gaps, the flywheel might not generate much force.
Okay, moving on. Chapter 2, Management Evaluation. Who's running the show here? What's their background?
The main guy is founder and CEO Matt Ehrlichman. He was there from the start, had previous tech experience with Thriva, Active Network. Key folks include Matthew Neagle, the COO, who's been with Porch a while, and Sean Tabak, the CFO, who joined more recently. They've also brought in some experienced leaders from bigger established companies lately. It seems like they're trying to build out their operational muscle for this new phase.
And their track record. You mentioned it hasn't exactly been smooth sailing.
No, definitely not. They had financial struggles before the SPAC deal. Post-SPAC, yeah, revenue shot up, but mostly through buying other companies. And they consistently lost money on a net basis until 2024, when they finally hit positive adjusted EBITDA for the year. Small steps. But then the PRCH launch seems to have gone well, and Q1 2025 was strong. I mean, actual cap net income, good cash flow, raised guidance. That points to maybe a real corner being turned recently.
He also had that Vest 2 issue hit HOA back in 2023. How did management handle that crisis?
Yeah, that was a big deal, the reinsurance fraud. Their response seems pretty solid, actually. They went after the parties involved legally. They got a $7.1 million settlement. And importantly, they managed to get new reinsurance lined up for PRCH, supposedly at better rates. Considering how messy Vest 2 was for everyone involved, navigating that and getting PRCH reinsured seems like a win for them.
How are they on communication? Are they transparent with investors?
They seem pretty active. Regular earnings calls, presentations, they did an investor day. And importantly, with this big PR shift, they introduced new reporting segments focused on Porch shareholder interest, trying to give a clearer view of what drives value now.
Now, we do have to talk about those past ethical concerns. That 2021 short seller report raised some serious flags. What were the main accusations?
Right. The Spruce Point report from 2021, it made some heavy claims. Things like hidden deals, questions about the CEO's background accuracy, and some pretty concerning accounting stuff. They pointed to a big stock compensation charge for a small deal, how they recognized barter revenue, and whether they exaggerated what some businesses could do. There was that Candela lawsuit alleging vaporware. Now look, short sellers have an agenda, right? They want the stock down, and this is old news. But the nature of the claims, especially around accounting and business descriptions, means you have to keep them in mind when looking at today's numbers. We should probably also mention the CEO's pay in FY24 was quite high, especially given the history of losses before that.
So pulling all that together, your assessment of management's capability, honesty, shareholder focus.
Capability, I'd say yes, especially seeing them execute the PRCH shift and deliver strong Q1 results. Honesty, the past allegations mean you need to be cautious, scrutinize the disclosures carefully. Shareholder orientation, plausible, given the CEO's big stake. But those past concerns in the compensation picture add some caveats.
Okay, insight 2.1 on the management story.
They've definitely shown they can adapt. Startup, SPAC, acquisitions, Vest 2, now PRCH. They've navigated a lot. And Q1 25 was objectively good execution. But you can't just ignore the history of losses and the big pile of debt they accumulated along the way. It's a contrast.
And insight 2.2, the relevance of those Spruce Point claims today.
There's still relevant context, I think, especially when you're evaluating the current financials. How are they recognizing those PRCH fees? Are the business descriptions accurate now? Those past questions about accounting and representation linger, and that Candela lawsuit is still out there. It warrants continued attention.
Let's shift gears. Chapter 3, Financial Health. Big changes in the business. What do the numbers look like now as of early May 2025?
Well, the first thing you notice is the stock price jump after Q1 earnings, up around $7.30. That puts their market cap at roughly $745 million, PE ratio. Still not very useful. They've lost money historically, and forward estimates were negative before Q1. That might change now, but it's early days.
What about revenue growth? It was fast and slowed. What's happening now?
Yeah, rapid consolidated growth from 2020 to 2023, then a slowdown in 24. Q1 25 is tricky for year-over-year comparisons because of PRCH. The key number now is that Porch shareholder interest, or PSI revenue. It was $84.5 million in Q1. Interestingly, total consolidated revenue was actually down 9.3% year-over-year, but management raised their full-year PSI guidance to $420 million. So they expect that core part of the business to keep performing well.
And profitability. That seems like the biggest change with PRCH.
Huge change. Q1 PSI gross margin was 82%. That's massive. Insurance services at 85%, software 75%, consumer 83%. Compare that to historical consolidated gross margins around like 48%. Big difference. Consolidated operating loss in Q1 was small, $1.2 million, but the PSI segments together made $1.2 million before corporate costs. PSI adjusted EBITDA margin was 20%, and the headline number. Q1 net income attributable to Porch was $8.4 million. A PSI net margin around 9.9%. That's a major swing from the consistent net losses they used to post.
Okay, but debt is still the elephant in the room, isn't it? What's the situation there?
It absolutely is. Debt to equity isn't meaningful because equity is likely negative. We need the 10Q for confirmation. What matters is the total amount, $507.1 million at the end of Q1. And the critical part is $173.8 million of that is due September 2026. That's not far off. They did some refinancing in 2023, pushed some maturities out, but at higher rates. They bought back a small bit of the 2026 notes in 2024. But that near-term maturity is a major hurdle, especially with negative equity limiting their options.
Any brighter spots on cash flow?
Actually, yes. Q1 PSI operating cash flow was positive $27.2 million. Now, that did include $7 million from that Vest 2 settlement recovery. But still, it's a significant positive number, and they project CapEx to be pretty low, like $6-7 million a year. So that suggests they could actually start generating positive free cash flow, which would be a huge turnaround.
Okay, Insight 3.1 on financials.
The Q1 turnaround is dramatic. Profitability, cash flow. It's a completely different picture under the new model compared to the old days of losses and high capital needs.
Insight 3.2.
Management talks a lot about adjusted EBITDA, which is fine, but getting to positive GAAP net income and positive operating cash flow in Q1, that's really significant. That's the cash you actually need to pay down debt and reinvest.
Insight 3.3, emphasizing that debt wall.
Yeah, that $173.8 million due in September 2026. It's the critical near-term challenge. They need to keep generating cash consistently to deal with that, especially since negative equity cuts off other avenues.
In Insight 3.4, the Porch-PIRE connection.
Right. Porch doesn't have the direct catastrophe risk anymore. PIRE does. But Porch's whole income stream, the fees, the interest depends on PIRE being financially healthy. If PIRE runs into trouble, Porch feels it directly in its earnings and the value of those notes. Their fortunes are linked.
We've covered a ton already. Let's take a quick pause. Yeah. When we return, we'll look at market sentiment, ownership, and wrap up with the risks and our final thoughts. Stay with us. Welcome back. We're diving back into Porch Group. Let's pick up with Chapter 4. Market sentiment. How's the market feeling about Porch right now?
Well, the reaction to Q1 earnings was definitely positive. That stock price jump tells you a lot. It builds on some gains over the last 6-12 months, though it's still way off those highs after the SPAC deal. The stock's pretty volatile, high beta around 2.4. Headlines really focused on the earnings beat and raised guidance, all tied back to PIRE. It seems the market maybe didn't fully appreciate the potential of that PIRE shift beforehand.
What about the analysts? Are they buying into the story?
It's kind of mixed. Ratings range from hold up to buy or outperform. KBW, for instance, kept a market perform rating and a $7 target after Q1. Their reasoning was basically valuation complexity and the leverage. Before Q1, some others were more bullish, targets like $8 to $10. Consensus EPS for FY25 was negative before the results, but you'd expect that to get revised upwards now.
Okay, and what about short interest in options? What clues are there?
That's interesting. Short interest is still really high. Mid-April numbers showed over 11 million shares short. That's like over 10% of the float, maybe 4 or 5 days to cover. So even with the good news, there's significant skepticism out there. Implied volatility in the options is also sky high, around 119%. After earnings, yeah, there was more call buying. But looking at total open interest, puts and calls are more balanced. Lots of action around the $7.50 call strike. That high short interest means there's a real disagreement. Could lead to a short squeeze if things stay positive, or the bears could be proven right if they stumble. Definitely signals continued volatility.
All right, Chapter 5. Ownership structure. Who actually owns Porch?
Institutions are big players here, holding over 50%. Granahan Investment Management has around 11.7%, Fidelity near 6%, BlackRock, Vanguard around 5.5% each, Portalon too. So what these big funds do matters. Insider ownership is also very high. CEO Matt Ehrlichman has something like 22% himself. That's over $100 million on paper now. That definitely suggests his interests are aligned with other shareholders.
Any interesting insider buying or selling recently?
It's mostly selling over the past year. But you have to look closer. A lot seems to be automatic sales under 10b5-1 plans or for taxes when stock vests. The COO, Matthew Neagle, did have an open market sale, though. So net-net, it's been selling, but maybe not all of it is discretionary.
And how concentrated is that ownership?
Very. The top 7 or 8 holders have about 51%. Top 25 have over 70%. That doesn't leave a huge amount for the general public, maybe 20–26%. It means the big institutions and the CEO hold a lot of sway. Creates an interesting dynamic.
What about corporate governance, the board?
It's the CEO plus 7 independent directors. They have a lead independent director, independent committee chairs. Average tenure for the independents is just under 4 years. Seems pretty standard.
And ISS. What's their take on governance quality?
As of early May 2025, ISS gave them an overall score of 6. That's moderate risk. Breaking it down, audit got a 10, higher risk. Shareholder rights was a 7, also higher risk. Board and compensation were moderate, 5 and 6. That high audit score could relate to things like how long the auditor's been there, non-audit fees, maybe internal controls. Connects back potentially to those Spruce Point concerns. And the shareholder rights score suggests maybe some limits on shareholder power.
Okay, Chapter 6, Risk Assessment. Let's do a quick SWOT. What are Porch's strengths?
Strengths. I'd say they're unique data access from the software, the integrated model trying to capture the homeowner journey, strong niches in their software verticals, plus the transformed business structure with PRCH, high margin potential there, and the recent performance momentum from Q1.
And weaknesses?
Biggest one is the debt burden, especially that 2026 maturity. Negative shareholder equity is a major weakness too. Also, the history of unprofitability, the complexity of running all these different parts, and their heavy dependence now on PIR's health.
Opportunities ahead.
Scaling up the PR management side seems like the main one. Monetizing their data better, improving that cross-selling flywheel, riding growth in prop tech, insurtech, home services generally, software tweaks, price increases maybe, and potentially strategic M&A.
Finally, threats. What could derail them?
Economic sensitivity is big, housing market, interest rates. Competition is fierce everywhere they play. That debt refinancing risk in 2026 is huge. Regulatory scrutiny, especially around data, AI, insurance. Execution risk, can they really make this new model work long-term? Reputational risk from the past, indirect catastrophe risk via PRE, and broader economic stuff like those U.S. tariffs.
On a tariffs management doesn't seem too worried directly.
Yeah, they said limited direct impact, maybe mid-single-digit millions on EBITDA, already in guidance. Because they're mainly software and services now. Makes sense. The indirect risk is the worry. If tariffs slow the whole economy, hit housing, hit home services, that affects Porch, even if they don't import much directly.
Okay, we've covered a lot. Chapter 7. Let's wrap this up. What's the overall picture?
It's a company in the middle of a massive transformation. The PIR model shift is potentially huge, and Q1 results were impressive. But you have the massive debt, the negative equity, the lack of a long track record of profit under this new system, and all those other risks we talked about. It's complex.
If we look through, say, a Warren Buffett lens, does Porch fit?
It struggles with a lot of those principles. Simplicity, not really. It's quite complex now. Long-term economics. History is shaky, future potential is unproven, conservative financing, definitely not with that debt level. Consistent earnings? Nope. History of losses. Margin of safety. Hard to see a clear one given the debt and uncertainty. It feels much more like a speculative turnaround play than a classic Buffett-style value investment.
So the final investment thesis for Porch today?
I'd frame it as a speculative turnaround. The PIE shift could be a game changer. The data's valuable. But the risks, debt, negative equity, unproven long-term success are substantial. It's not for the faint of heart. More conservative investors probably want to see sustained profits and real progress on paying down that debt before jumping in.
Which brings us to the critical follow-up question, doesn't it? Our end hook.
Exactly. The next thing we really need to dig into is PR itself. How sustainable is its underwriting profitability? Because that is going to determine Porch's long-term stability and success. Understanding PR's health is absolutely key to knowing if this transformation really works out for Porch.
Really insightful stuff. If you found this deep dive helpful and want more analyses like this, definitely hit subscribe on the Stock Analytics AI YouTube channel.
Yeah, and just the usual reminder that this was all for informational purposes, based on research up to May 7th, 2025. AI was used to help prepare this content. Always do your own thorough research before making any investment decisions.